So millions of Americans are about to lose their jobs. And in this video, I'm going to talk about how that's going to play a role into the crypto market with XRP sitting at 50 cents, Bitcoin sitting at $26,000. In this video, we're going to be discussing the government shutdown to potentially happen in the next 3 days if no deal is reached. We're talking about the debt ceiling limit. What is a government shutdown? Why are we likely to have another one? What happens to things like Social Security payments if the government shuts down? We're also getting into the charts. We're talking about Bitcoin on the macro market cycle, XRP to the US dollar. We're talking about unemployment, the unemployment rate over the past several decades, how this plays a role into the stock market for a potential stock market meltdown, government bond yields, the price for government bonds, the 2-year versus the 10-year, comparing other countries as well too, and then what Congress is most likely to do next. So comment 777 if you're feeling blessed, comment 777 if you're feeling bullish. And if you're going to become the first millionaire in your family tree, confirm it by liking the video, subscribing to the channel, and let's run it. All right, bull runners, welcome back. So we have some exciting things happening behind the scenes on bullrunners.com, and we're going to be having some amazing crypto news, finance news, investing news, charts, analysis, lots of stuff on bullrunners.com. If you guys want to check that out, it is not yet live, so hang tight. Once we drop that, you're going to be getting the best information every single day of what's happening in the finance space, because we provide you with the best, not the breasts. We're not that type of media brand, okay? You can go check out OnlyFans for that. But we provide you with the best so you could get ready for the worst. Prepare you, right? Preparation is the best cure. So when we look at Bitcoin, So if you're trying to cure your financial problems right now, to become wealthy, to become the first millionaire in your family tree, understanding macro market cycles and fundamental analysis is key, but also understanding some technical analysis. Because when we look at Bitcoin's logarithmic chart on the monthly right now, and we compare it to the past market cycles, if you guys didn't see my previous videos talking about where we are in this accumulation phase right here, if we were to look at the stochastic RSI and see, when we are over 70 on the RSI, and what's happened in the past, the previous time that we were above 70 and we went drastically to downside closer to 30 was the first peak of the previous bull run in 2021. The time before then was during that 2019 rally when we were on the downside. A time before then was at the peak of the market in 2017. A time before then was 2016 January, before we actually went on a massive bull run. Then, a time before then was back in April of 2013. So obviously we can't say we're at the top of the market, because on the RSI comparing to the top, we saw when we were at 91 right here back in March of 2021, we were upwards of 94 back in December of 2017. And then for the previous peak of November of 2013, we were all the way upwards of 96. So right now we're at 48 on the RSI, and this is comparable to 2019 right here, and also 2016 right here before the next bull run took place. So the accumulation phase is what we're in. And the accumulation phase is boring, it's frustrating. It also makes you feel a lot of fear, because you hear a lot of noise out there in the media, like Binance melting down, government shutdown, all this crazy stuff. And you're wondering, how is this going to affect the crypto market? But the general thesis is we're going up long term. But there's also some looming problems on the horizon to be on the lookout for, because, if we bounce off of the RSI-based moving average and we trade to the upside and we go back into the next bull run leading to 2025, would the meltdown for the economy, the stock market crash, the global economy crash happen in 2026, leading us into the next bear market, or would it happen before then? And how would that affect XRP? Because looking at XRP as well too, when we look at the stochastic RSI, we were at 87 on the stochastic RSI, up here, post lawsuit, and on the RSI we were at about 54. So we weren't too far into oversold territory compared to the past. When we were at the peak up here of 95, when XRP was upwards of $3 for almost $4. The high of 2021, we were above 70, so we were at 74. So XRP is sitting at 49 on the RSI in neutral territory, comparable to right here for 2019. But on the stochastic RSI, we are sitting at, about 64 right now. So if we were to compare in the past of where we were, back in 2020. And we saw massive volatility take place, but we were in the middle of a bull run. Very similar back to December of 2016, on the stochastic. We were at 58 right here. Some volatility to the downside, then trading the upside. So if Bitcoin sees a sell-off, obviously XRP would see a sell-off in this macro symmetrical triangle. But ultimately, I talked about this in the last video, how even if XRP goes down to 40 cents, 38 cents, if it trades below this upward trending support right here that we were to mark from March of 2020, that would come at the backs of, potentially the stock market getting obliterated sooner than everyone expects. But I think by 2026, we're going to see something absolutely insane happen in the markets due to unemployment. So I want to talk about unemployment rising from 3.5% to 3.8% and what's most likely going to happen over the next few years. And when this does happen, how do you prepare yourself? So looking right here, civilian unemployment rate, sitting at record lows comparable to pre-COVID, also comparable back to right before the dot-com bubble burst. We're even lower than we were before the 2008 subprime mortgage crash, almost all the way back down to 1968. So record low unemployment right now is not a good thing. And when I draw the chart up next to the S&P 500 index and we compare what happened the last times that unemployment spiked up and what that did to the market, the previous time was for COVID when unemployment rose, from 3.5, 3.6%, where we are roughly today, to upwards of 14.7%. Arguably, I think it was even higher than that. Some charts shows like 19%, depending on where they're getting their data from. And so the markets dropped 34% for COVID. The S&P 500 dropped 34%. Now, if we look at the time before then and we see what happened from, 2007 to 2009, unemployment went upwards of 9% from 3%. What happened in the markets there? Well, that dropped the S&P 500 57%. The time before then was the dot-com bubble boom. And the dot-com bubble boom, unemployment went from 3.79% to 6.3%. And it took 3 years for that to take place. So 2007 to 2009 was 2 years. COVID was a lot quicker. So that's why the crash was more sudden. It took 3 weeks in the crypto market for your portfolio to drop. If we were to look at Bitcoin, Bitcoin during COVID, how quickly did that happen? It was less than a month. And you saw your portfolio drop 60% in less than 30 days. So because crypto is more volatile, it moves faster, crypto is affected much quicker. And it's very hard to prepare for that because you wake up, you got to go to bed, right? Maybe you might sleep 5 hours a night, 6, 7, 8 hours a night, but you go to bed and you wake up and the market's crashing, 5, 10, 15, 20% in 24 hours. You can't prepare for something like that unless you have your stop losses set. So when unemployment spikes up, which it will, the real question is when and how long will that spike go for, and how much of a impact will that have on the stock market, on precious metals, on real estate, on cryptocurrencies, on the assets that you're holding. Now, a 50% drop took place from 2000 to 2003, March of 2003. Actually, it was July of 2002. But even before then, we look at 1990s was the last time before then that the unemployment went from 5% upwards of 7%. So every single time, 1, 2, 3, 4, the past 4 times, if we're just measuring the past 4 times, we can go back even further than that. But every single time that unemployment has gone up, the stock market has crashed. Okay? So it's not a question of if it'll go up. It's a question of when it'll go up, and it's not a question of if the market will crash. It's a question of how much are you going to lose if you're holding stocks. That's why I'm not touching stocks right now. So if we were to measure 54%, let's just say 54% from the high, what would that take us to? Well, that would take us to the levels that COVID hit. That would also back test this area right here that acted as resistance back in 2015. Could we come all the way back down here? Would we stop short at 3,388? Would we come and break the previous low? That's the real question. Nobody knows how low we would go, but based on how much money and how much debt's out there, I think it's going to be big. And it could be bigger than, I think it might be bigger than 2007 to 2009 in the dot-com bubble boom because there's more liquidity out there. Now, when we look at U.S. government bond yields, the bond prices tend to bottom before, once they bottom and they start reversing, then the stock market starts to follow for that. And so if we're looking right here, on the RSI for the US government 2-year, and then the 10-year yield, we can see right here was 2018. Similarly, we were up there as well too on the 10-year. We weren't quite as high on the RSI, but right now we're sitting at 74 on the RSI. We were upwards of 89 on the RSI. So something has to give, and I've talked about this in previous videos, where the relative strength index is going to flip. We're going to trade to the downside, and that's going to come at the backs of the bond yields dropping and then bond prices going up. So we're at 4.607% on the 2-year, and we're at 5.13% on the 10-year. And so, actually, sorry, we're at 4.6% on the 10-year and 5.137 on the 2-year. So because the 2-year is higher than the 10-year, we have an inverted yield curve. And that just simply means that, you know, short-term treasuries yield a higher percentage than long-term treasuries because people are expecting an economic downturn, a recession. So a recession is on the horizon, and that brings me into the news for today, which I'm going to be talking about in a little bit, about a government shutdown. And so when we look right here at the 10-year prices, you know, sitting at 107 compared to where we were in 2020 at 140, this is not good at all. Right here on the RSI, we're sitting at 29. What does it mean, guys? Very simple. You understand this stuff. I don't have to insult your intelligence. I'm just showing you this stuff so you can be ready for it. Meaning anything below 30 is oversold conditions. And so when we go below 30, what's the next stop? Let's go up. We have to go up on the RSI. We have to go down in terms of yield prices. We have to go in terms of yield percentages. We have to go up in terms of bond prices. And the real question is, if we go lower, sure, we could go lower. We could dip below 30. We could stay here for an extended period of time before we go up. I mean, if we were to measure the last time we were down at about 104 on the price was 2006. That lasted about 427 days before we started getting out of there. And then about 500 days later, we started blasting out of here back in 2007, right before the subprime mortgage crash right here. The bond yields. This is what I'm looking at. So we're in similar territory right now for that, but we're even higher on the yield percentage compared to 2018. If we go back, we're touching the same yield percentage levels that we were at on 2006 to 2007. And also simultaneously, look at what happened. The RSI peaked, and then we started trading to the downside on the RSI. So the RSI, I believe it already peaked back in September right here, and we're seeing this dead cat bounce on the RSI, and we're going to start going down right now. The government doesn't know what to do. That's why the potential government shutdown is being talked about right now. And so where are we going to go, and how low would we go? And then, you know, how long will it take before the bond prices to spike up? And when will we get out of this inverted yield curve inversion is the real question. Now, looking back to 2018, when we dropped all the way down to 117 on the 10-year notes, and then we rose all the way up to 140. Well, the RSI was sitting at 31. What happened to the RSI? It rose upwards of 70 plus. We're at 77 over bought conditions, right? Down here was oversold. Up here, right here, was over bought conditions. And so because we were in overbought conditions, the price was high, but the yields were down at 0.1%. So 0.1%. And then the RSI simultaneously was below 30 on the 10-year yields. And then the RSI was above 70 on the pricing. So when bond prices fall, the yields rise, right? They move inversely of each other. And then when bond prices rise, the yields fall. And so because we're high on the yield, we're going to go down. And when we go down on the yield, we go up on the price. Okay. Now, how's that going to affect the rest of the markets? I mean, you look at the United States. I'm just talking about the United States. The rest of the world's going to be impacted. You see the yield percentage for Brazil, it's at 11.77%. Russia, 12.7%. This is unsustainable. This is going to end in a massive disaster. Unless Congress acts soon, the federal government will shut down again. Government funding runs out at 12:01 a.m. on October 1st, just a few days. Maybe if you're watching this video after this, you know, maybe they came out with a deal, or hey, maybe catastrophe striking, and you know, you're seeing this before it happens, and that's why you're subscribing to the channel. So meaning Congress has just a few days to come up with a solution so that millions of federal workers don't potentially lose out on getting paid. Everyone wants to get paid, right? If the federal government shuts down, numerous publicly funded agencies will stop work and their employees won't be paid, but Social Security checks will still go out. Social Security is considered a mandatory program. It isn't funded by the shorter term appropriations bills passed by Congress and signed by the president. This means its operations and funding don't stop when the government shut down, which is good news for those on Social Security, but it's bad news overall for the rest of the economy, and I'll explain why. It's important for a large portion of Americans, as about 67 million people receive monthly Social Security benefits, according to the Social Security Administration. Those benefits go primarily to retirees, but also to people with disabilities, as well as dependents of deceased beneficiaries. So Medicare and Veteran Affairs benefits also will continue to be distributed during a meltdown. So, real question is, why do government shutdowns happen? And then, does that lead to a meltdown? Under the Anti-Deficiency Act, initially passed in 1884 and amended in 1950, federal agencies cannot spend or obligate any money without an appropriation or other approval from Congress. When Congress fails to enact the 12 annual appropriation bills, federal agencies must cease all non-essential functions until Congress acts. This is known as a government shutdown. If Congress enacts, but not all of the 12 appropriation bills, only agencies with appropriations have to shut down. This is known as partial shutdown. So simply what this means is they raised the debt ceiling. No, they suspended it until 2025, but they just can't decide what they're going to spend the money on and what they're going to put it towards. Are they going to send half of it to Ukraine, or are they going to improve the infrastructure here in the United States? I think the answer is obvious on where that's going. So why does the shutdown look likely in the fall? This year, towards the end of this year, 2023, before 2024, in June of this year, with the backing of Republican leaders in the House, Senate, Congress passed and President Biden signed the Fiscal Responsibility Act, which lifted the ceiling of the federal debt and set limits on annual appropriate spending, one for defense, one for non-defense, for the fiscal year of 2024, which begins October 1st. And this leads to 2025 as well, too, up until the limit is unsuspended. At the same, the expectations were that this settled the overall size of the appropriations bill, and Congress would pass 12 bills that added up to the agreed upon levels. The Senate Appropriations Committee has followed that path and has passed all 12 appropriations bills with bipartisan support. The House Republicans, unhappy with the agreement, Speaker Kevin McCarthy, struck with the White House, wants to spend less than the levels specified in the Fiscal Responsibility Act, much to the consultation of Democrats in the White House, which says that Biden would veto the appropriations bills that are pending in the House. The House bills also include provisions on abortion, contraception, regulation of tobacco, and healthcare for trans persons that aren't likely to pass the Senate. And so we're focused on what's going to happen to your money here and how common is this? Because there's been 4 shutdowns, which operations were affected for more than one business day between 1995 1996. Clinton and the Republican Congress were unable to agree on spending levels. The government shut down twice for a total of 26 days. In 2013, a standoff over funding for the Affordable Care Act resulted in a 16-day shutdown. And in December of 2018 and 2019, a dispute over border wall funding led to a shutdown that lasted 35 days. And so, previous times that this has happened, what impact do government shutdowns have on the overall economy? And do you have to be worried? Because a shutdown could last a few days. One of the few days is just a hassle and undermines public confidence in the capacity of U.S. politicians to do the people's business, just like their credit rating was slashed because they couldn't adjust the debt limit in time. And it was like last minute, like you would be cramming for a test in high school. And they're just, freaking out over what to do as Janet Yellen, stutters over herself, trying to convince Congress to act. However, it can cause bigger problems, albeit most temporarily. Goldman Sachs estimates that a shutdown would reduce GDP growth by about 0.2% percentage points each week that it lasts, and that growth would rise by the same amount in the quarter following the shutdown's end. The Congressional Budget Office estimates that the 5-week partial shutdown in late 2018 and early 2019, it was partial because 5 of the 12 appropriation bills had been passed, reduced the level of GDP growth by 0.1% in the fourth quarter of 2018 and by 0.2% in the first quarter of 2019, which is about $8 billion, mainly the loss of furloughed federal workers' pay and the delay in federal spending on the goods and services. Although most of the real GDP lost will eventually be recovered, CBO estimates that $3 billion will not be. In other words, the GDP in 2019 was estimated to be 0.02% lower because of the shutdown that it otherwise would have been. The CBO estimates did not account for such indirect effects as the inability of some businesses to obtain federal permits or apply for federal loans. And so, it's not going to affect it too much. What would affect the economy more so than that would be the unemployment, the bond yields, the bond prices rising, bond yields going down. And so that is going to happen at some point in the near future. Now, the real question is, will the stock market crash be larger than 54%, bringing us back down to the levels of 2009 and 2002, comparable to the crash of 1929 and lasting, several years before he broke out of there, 20 years? Could that be happening? I think that something like this is definitely in the works, not to get you guys to freak out, but just to look at this, the Fibonacci retracement from the year 2000 all the way down to the low of 2009. If we were to draw that, we've already done a full extension. We're above a full extension right now, and this could be considered the dead cat bounce that's taking place for this recovery rally of the stock market right here. It looks eerily similar right here. If I were to trace it up side by side, where we saw the peak of 2021 during that bull market, and then this bounce right here is comparable to the bounce of 1930 before then we dropped off a shelf and got absolutely destroyed from that. What would cause this? Well, while the market is crashing, the Fed would have to step in and try and issue in some QE, quantitative easing, but by then the markets would already be dropping down. So if we're looking at the moving averages here, the 50 moving averages, the 200 moving average, so the 50 is still above the 200 moving average. And if we were to compare this to 2000 and or 1930 right here, we're still above the 50 moving average, whereas comparable down here, we were below the 50 moving average. We bounced down to the 200. The dead cat bounce was up to the 50, and then we dropped down and we saw the moving averages cross. And so could we push higher? Absolutely. We could have another peak, and then ultimately this could happen by 2026. So it doesn't mean that's going to happen right away, because this retracement right here could be the final push up, and then by 2026 is when we see the crash around. But at some point, this 50 moving average is going to curl around, the 200 moving average is going to cross it, and then we're going to be seeing one of the worst crashes in history. Now, it's going to happen within our lifetime, but when will that happen? Let me know your guys' thoughts in the comments below. And do you think that it's going to be as big as the 1929 to 1932 crash? That only took 3 years for the bottom to be in, and we saw the stock market drop, from 32 on the S&P. It dropped over 86%. That's looking like Ethereum's crash right there in terms of percentage points. And so what we're going to be doing is we're going to be backing up our truck all the way to the bank, grabbing the bags, packing them, stacking them, leaving no bags left behind, because the spending power of the dollar is going to continue to go down in value. That's a fact. And blockchain technology is going up in interest. That's the truth. Together, we're all going camping on the beaches of the moon. So I will see you guys on the next video. If you want to stay up to date on the markets and get the best information to prepare for the worst that's yet to come, go to bullrunners.com. You might see it coming soon, or we'll be back soon on the page right now. Once we go live with this page, you guys are going to get the up-to-date, latest and greatest information on what's happening in the world of finance. So as always, I will see you on the next video. I will see you on bullrunners.com. You know what to do. Stay bullish.